If you're looking to open a fine or casual dining restaurant, you're looking to put in hundreds of thousands of dollars into your restaurant, most likely. And you're probably going to need to raise some money from outside investors or lenders. And those investors or lenders are probably going to ask you for a set of financial projections for the restaurant. And so what we're going to do here is walk you through our restaurant financial projection template that we've been working on and iterating and improving for nearly a decade now here at ProjectionHub. And we help entrepreneurs from all sorts of different types of businesses create financial projections for investors and lenders or just internal planning. And so in this video, I'm going to walk you through the template, show you how to enter in your startup costs, your common operating expenses, help you create a set of revenue projections and sales projections based on your specific plan. So are you going to be open for breakfast, lunch, dinner? Are you going to do takeout? What's your price point for your menu? What capacity do you think you'll be at? Is the business seasonal at all? All of these things we're going to walk through and show you how to be able to enter in these assumptions that will ultimately allow us to see whether the business should be profitable and whether it should cash flow. And ultimately provide a number of pro forma financial statements, but also a number of nice graphs, charts, tables that you can use to present to investors or lenders as well. Again, my name's Adam Hoeksma, and I'm the co-founder of ProjectionHub, and look forward to diving into this template in a lot more detail. All right, so if you grab the template from the video description below, we've linked to this template, but what you'll see in the template is that every cell that is highlighted in light blue is an assumption that you can change without breaking something in the template. So the first thing I'm going to draw your attention to is we're going to put in, be able to put in investment. And now, there's a number of slots here, so you may put in some personal investment yourself. You may have, let's say, well, you're not going to put in, maybe you won't put in 300,000, maybe you'll put in, you've got 100,000 you're going to put into this restaurant, and you have outside investors that you're hoping to raise 200,000 from. And we put month zero, that's basically the startup at the beginning. Month zero is when that investment's coming in. Now, down here I want to show you these fixed assets. This is a lot of your startup cost, right? So you're going to have your build out of your building. And of course, this could vary dramatically depending on what you're doing, depending on if the space you found, if you're renting space, was it a restaurant before? How much work did it need? So this can really vary dramatically. Now, if you aren't renting space and improving it, if you're actually building new space that you'll own, what you could do, and show you, you can add a building instead. And let's say you own the building, and the building is, maybe you paid $500,000 for it. So that's how you enter that, maybe instead of doing the leasehold improvements, right? So I'm going to delete that because in this example, we're going to assume that you're renting the space and you invested in leasehold improvements. Now, you also have your kitchen equipment that we've estimated at $80,000 here. Furniture at $50,000, signage at $15,000. Of course, these numbers, you could spend $100,000 on signage if you wanted to. Do your own research, figure out based on your business plan and your layout of your restaurant and your specific location what these things are going to cost, and enter them into the spreadsheet. Now, we're assuming that we're going to apply for an SBA loan. So we're asking for a $500,000 SBA loan. 4% interest is probably too low. We should assume 8% interest. And it's a 10-year, 120-month loan. That's what we're hoping to get. So we've got $300,000 of investment coming in and $500,000. So total sources of funds are $800,000. This little table down here shows you, based on the assumptions that we have in here, how much cash is needed, plus a recommended buffer. And then it's going to say, do we have enough? Do we have enough here? Do we think we have enough to be able to cash flow. So based on the assumptions now, we're in good shape. Let's jump over to our input revenue tab. So this is a bit of a beast, but what you'll see here is that you can put in your the number of seats in the restaurant, the number of days that you'll be open, your average party size. So put in 2, you can see how things change when you do 4 or 3 or various numbers. So you'll be able to play around with that. Maybe we'll say 3 for this example. And then it depends on what you're going to serve. Are you going to serve breakfast, lunch, dinner? But we have slots here to allow you to add assumptions for breakfast, lunch, dinner, even an other category, and then takeout as well. And so you'll enter in for each of those, how long do you think the average customer is going to be there for the meal, for that particular meal? And it could be different. Breakfast or lunch might be shorter than dinner might be, right? And so you'll be able to change those assumptions. This is how many hours you expect to be open for breakfast. And then based on that and the number of seats you have, this will calculate how many potential customers per month you could have. And then what we'll ask is that you fill out what % capacity do you expect to be filled in the restaurant. So basically it's saying for those 3 hours of breakfast, we expect to be at 20% capacity this is month 1, right? And so you have the ability here, if you're in an area where, or just the restaurant type is very seasonal, you can change the percentages. So, maybe even if you're closed, let's say you're closed in a particular month, but then you're really busy later on, you think, not 750% capacity, 75% capacity. So you can see how you can change those percentages. And then the model will assume that it follows a similar seasonal pattern for future years. So you kind of set your first year seasonal pattern, and then the model will follow that for future years. You can set a growth rate. So this is a growth rate in your capacity. So if you think over the years and months, you'll increase your capacity, you can enter that there. And ultimately now we're going to be able to calculate the total number of monthly customers that you expect based on these assumptions. And now this is just for breakfast. Keep that in mind. Customers per day and per hour. Now we get into adding our general menu items. Now we don't, this model doesn't have you enter in every single menu and say we think we're going to sell, 6 hamburgers and that sort of thing. What we're really trying to get at is some basic ticket size for an order. And so you put in these assumptions. You've got your price point, and then this is your cost. What do you expect your cost to be? So you can see up here what we have is that we have that set at 0.4, so 40% food cost for a large entree. And you can see right now we just have 40% as a food cost for everything. Now you could go in and change that, depending on the menu item if you'd like. And then over here, you'll want to put in the average person that comes in and orders, how many of each item are they going to order. So when we put in 0.5 between the large entree and small entree, essentially what that is saying is that half of people are going to order a large entree, half of people are going to order a small entree. And then you can see these additional items here that people can order. Now it's breakfast, so maybe 80% are ordering coffee, right? And you have the ability to do alcohol sales are broken out separately, so you could do breakfast cocktails as well here. And really, you're going to go through that same exercise for lunch, dinner, other hours that you might be open, and then takeout. And all of that's going to ultimately generate your projected revenue. And we have that broken down between food and drink revenue, alcohol, and takeout revenue. Now jumping over to our direct cost tab. Now this is where we're going to look at, the different staffing expenses. So you have your servers. You're going to put in different assumptions about, we already know we're open 84 hours based on the assumptions from the other tab. But there's going to be opening and closing hours that you'll need staffing for. And so we're assuming 14 hours per week of extra staffing time when you're not open for customers yet, but you still need to staff the restaurant. And you'll be able to just kind of see, you can enter in your own assumptions here, and price points, staffing costs for the different positions, and the number of those positions you expect to have. And ultimately that will help you calculate your direct labor expense. I'm going to move on to the other operating expenses tab here. And what you need to know on this tab, the main thing is that there's a drop down here that allows you to pick each expense that you have entered in here can either be a fixed percentage, which means it's the same dollar amount each month, essentially. And you'll see actually up here, we have the ability to add an annual inflation rate for those fixed expenses, or for any of the expenses. But so you'll see in like year 2, 3, 4, and 5, there's an increase in that expense. And that is based on this annual inflation rate. But otherwise, we're going to have, these are fixed expenses. Now, something like credit card processing fees, those are variable expenses and they're related to your sales, right? So what we have done, you can pick total revenue, for example, and then now these fields will be a percentage instead of a dollar amount. So when you put in 0.03, that means 3%. 3% of total revenue will go to credit card processing fees. If you have other variable expenses that are tied to revenue or tied to a specific type of revenue, you can also pick, just food and drink revenue, alcohol revenue, or takeout revenue, and then put a percentage of operating expense related to that specific line item of revenue. You can add your insurance, rent, utilities, software subscriptions, that you run the business on, that sort of thing, are all set up and built in here. And of course, you can add additional expenses down here in the spaces provided there. And then finally, we've got the ability to add salaried positions. So now keep in mind that if you enter a position on the direct labor, we don't want to double count that person over here. So just keep that in mind as you're entering in these salaried positions. So I've got a general manager, supervisors, and shift supervisors. So the way we have this set up, you can set a salary, benefits, what month that position starts, and then how many of that particular type of employee do you have? So you can see I've got 2 supervisors here, starting right in month 1. Both are starting right in month 1. But then when we get to a shift supervisor, we're saying as the restaurant grows, maybe we hire a shift supervisor, and but that doesn't start till year 3. So month 25 is when I have that set to start. You can set an annual raise percentage over here as well. So based on entering all that, the moment of truth here, we can see what our projected revenue and profitability looks like. So based on all of that, we are assuming 2.3 million in revenue with a 35% gross profit and a 9% net income. Keep in mind kind of some industry averages, and what you want to make sure of is that you're not like 50% net income when you're done, because every investor or lender is going to know restaurants don't generate 50% net income. So keep in mind these percentages and make sure they're kind of within the normal expectations for a restaurant, or if they're much higher or much lower, make sure you have a good explanation for why. And you can see some nice summary data like average spend per customer, takeout orders, revenue per takeout order, that sort of thing, some nice graphs and tables, and a breakdown of how you will spend your startup costs. All of these things can be helpful for raising capital from investors and lenders. And then you'll see a 5-year projected income statement, 5-year projected cash flow, 5-year projected balance sheet, and then you get all of those same reports in a monthly format as well. So 5 years, but by month of the income statement, cash flow, and balance sheet. That's really it. There's a lot here, and if you have questions or just comments about the template, please leave those in the comments of the video below. I'd love to hear from you and try to help you fill this out or make it work for your specific situation. If you need help customizing or just have some questions about it and want to reach out, support@ProjectionHub.com, and we will be happy to help. All right, thanks.